what can American businesses and citizens do to reduce the negative impacts that inflation brings about?
The government has set out lots of money to people. At some point, the money can't be worth as much as it was when there was less money out. In terms of inflation in our own businesses, it's extraordinary how much we've seen.
Currently, inflation is a hot topic for all of us. Not only investors and companies, but individuals are also massively affected by rising costs. In this video, Warren Buffett, who has experienced inflation firsthand many times and has built up his wisdom, will teach us which investments to avoid and which assets can outperform inflation. We will learn to become richer even in a high inflation environment. Before we get started, be sure to hit the like and subscribe buttons. Now, without further ado, let's dive into it. Now, holding cash during periods of high inflation is like holding a melting ice cube, Buffett once said. And the dangerous thing is that this process is not noticed right away. The money in your bank account or under your mattress is not getting less. It will be the same amount tomorrow and the day after tomorrow, but its value decreases. You can buy less for that money, and you might not notice it until your cube has already melted. You need to keep an eye on your spending power, not just the number on your bank statement or how high the pile of money under your mattress is. Let's do some quick math. If you get a 5% pay raise or manage to earn 5% more return on your portfolio, that's great at first glance. But in an environment with, say, 10% inflation, is it really that good? Well, this means you can buy 5% less at the supermarket even though you earned more. That's why cash is one of the worst assets when prices are rising. Not only does it not offer a return, but the return is actually negative when there is inflation. For this reason, cash is at the bottom of the pyramid of assets you want to own during times of rising prices.
Inflation, I should say, swindles the bond investor too. It swindles the person who keeps their cash under their mattress. It swindles almost everybody.
Another asset you want to avoid during inflation are fixed interest rate bonds. These are one step higher in the pyramid because they yield a return. Bonds are generally considered a very safe type of investment. However, inflation poses a similar risk in terms of purchasing power. According to Mr. Buffett, fixed interest rate bonds can be a poor investment during periods of inflation because inflation erodes the value of the fixed interest payments. When inflation rises, the purchasing power of the money you receive from your fixed interest rate bond decreases over time. In other words, the real value of the bond's future cash flows is reduced. It's similar to the pay raise example from earlier. If you invest in a bond with a fixed interest rate of 3% per year and inflation rises to 4%, the purchasing power of the interest payments you receive decreases by 1% each year. As a result, the real return on your investment is negative. This means that your investment is not keeping pace with inflation and you are effectively losing money. Looking at today's inflation rates, the result would be even worse.
If we dropped $1 million of cash into every household in the United States today, everybody would feel very good, except the people that invested in things that were denominated in dollars.
It should be emphasized, however, that while someone who invests in fixed-rate asset classes in times of high inflation will suffer from the effects of rising prices, conversely, someone who borrows money with a long-term fixed rate can benefit from inflation. Basically, the lender pays the difference between your fixed interest rate and inflation, leaving you with a profit. The reason for this is that inflation reduces the real value of the debt more and more over time. This allows the debt to be repaid with significantly less value-adjusted money.
If you own a home, though, with a very large mortgage and you have incredible inflation, it wipes out the mortgage, and you've still got the home. I mean,
in Weimar, Germany, they gave you the mortgage back at the end. Well, it's very interesting. That's the one thing they did right.
Let's look at the assets that can keep up with inflation, or in other words, assets that won't lose you money. Warren Buffett calls them unproductive assets. Unproductive assets are those that do not generate income. These assets include, for example, gold, collectibles, and other commodities that do not generate cash flow or income. The advantage of such assets is that they can provide a hedge against inflation. Since all prices are rising, they are likely to rise in value as well, and in theory, should at least keep up with inflation. The downside is, since they can't generate any actual income, they won't bring you any real profit either.
I would say this about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth at today's market prices about $7 trillion. that's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, you know, and maybe touching it, and fondling it occasionally, you know, and then saying, you know, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that. Add $1 trillion of walking around money. You know, maybe call me crazy, but I'll take the farmland and the Exxon Mobils.
With unproductive assets in third place, let's take a look at the assets that outperform inflation and give us a real profit and more purchasing power. This is where what Warren Buffett calls productive assets come into play. Buffett considers productive assets as those that can generate income or appreciate in value over time. This can include various assets such as stocks, real estate, and businesses, which have the potential to provide returns through dividends, rental income, or capital appreciation. Buffett believes that investing in productive assets is the key to creating long-term wealth, as these assets have the ability to compound returns over time. At this point, however, a distinction is necessary. As we know, businesses differ from each other, and each business operates under different conditions. The next level in the inflation pyramid is ordinary businesses. Ordinary businesses typically require a lot of cash to keep running.
Most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And you know, the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings.
Let me give you a quick example from the real world. Toyota is a Japanese automotive manufacturer that produces a range of vehicles. Let's say, for simplicity purposes, that Toyota has production costs of $20,000 for materials and labor to build a car. Let's also say that each car can be sold for $24,000. This would leave Toyota with a profit of $4,000 per car. However, let's assume that inflation increases by 20%, which means that the production cost of a new car is now $24,000, because costs for materials and labor have increased by 20%. As a result, the profit that Toyota has made in the past is now being used to offset increased costs, which means that the company has less money available to distribute as dividends or to invest in the business. Of course, we are nowhere near 20% inflation, but it illustrates that with high inflation, capital-intensive companies have less free cash available to distribute to shareholders. Now, let's take a look at another characteristic of ordinary businesses that you want to avoid during inflation. Stay away from businesses that don't have so-called pricing power. Companies with high pricing power are those that have the ability to raise prices without experiencing a significant decrease in demand for their products or services. This means that these companies have a strong competitive position in their respective markets, often due to factors such as brand recognition, high-quality products or services, or a unique value proposition. Some examples of companies with high pricing power include, for example, Apple, Coca-Cola, and Ferrari. Those companies have a strong brand and loyal customer base, allowing them to charge premium prices for its products compared to its competitors. Another example would be Visa and MasterCard. These credit card companies have significant pricing power due to their dominant market positions and the importance of credit cards in modern commerce. Conversely, companies with low pricing power tend to operate in highly competitive industries where customers have a wide range of options and can easily switch to alternative products or services. An example could be fast food restaurants. Fast food restaurants operate in a highly competitive industry, with many different chains offering similar products at similar prices. As a result, fast food restaurants typically have limited pricing power, while costs for labor, rent, and ingredients rise. Booking websites for flights or hotels also operate in a competitive industry, where customers have many different options to choose from. You probably don't mind which website you use, as long as you get the best price for the hotel room you want. Especially in times of high inflation, companies with low pricing power may face challenges in generating strong profits and returns for shareholders, as they are unable to significantly raise prices without losing customers. Let's now take a look at the investments you should really prioritize in times of high inflation. They are at the top of the pyramid of investments that can make you money when prices rise, outpace inflation, and give you more purchasing power. So, we have seen ordinary capital-intensive companies that rely on cash suffer from a rise in production costs. Now imagine the following. If a company can generate higher earnings due to inflation, but avoid rising production costs. Let's look at Amazon, for example. Amazon's core business is focused on e-commerce, providing an online marketplace for selling products directly to customers over the internet. This business model has relatively low capital requirements and can generate revenue by taking a percentage of each transaction that occurs on its platforms. Amazon offers a number of services to which this applies, for example in the area of machine learning or data warehousing. But let's stay with the e-commerce business for a moment. Once the website is built, with everything in place, the cost of maintaining it is relatively low. Of course, there are a lot of employees, but there is little to no cost for materials to produce a product, since most of the products offered on the site are not produced by Amazon itself, but third parties. This means that Amazon is much less affected by inflation. Companies like Amazon still have rising labor and infrastructure costs, but most of their business is resistant to inflation. Also, being one of the leading companies in its sector today, where most people in the English-speaking world have an account, gives it a competitive advantage that enables Amazon to increase the fees it charges for each transaction to the manufacturers of the products it offers due to high pricing power. This is the exact opposite of a capital-intensive business. Compared to the previous example of a car manufacturer, the services provided by Amazon is an example of a business that is much less dependent on cash, where only small reinvestments are required to keep the business running. This allows profits to be taken out of the business or invest them in other business areas without having to constantly reinvest them, leaving the shareholder of the stock with higher dividends or the potential for future growth. To find a business that performs well during inflation, look for companies with low capital needs, the opposite of an ordinary business. Such companies do not need to reinvest large sums to grow and often have strong brands like Apple or Coca-Cola, or do not rely on owning physical assets like factories or inventory like Google or Facebook. There are a variety of companies that fall into this category. Most businesses that produce software or some sort of digital assets or online marketplaces like Etsy or eBay tend to have low capital requirements. These businesses generate revenue from products or services that, once created, have relatively low capital requirements to maintain and operate the business. For the best investments to make money in a highly inflationary environment, two characteristics must be met. The business should have low dependence on cash and high pricing power. To find out if a company needs a lot of cash to operate, ask this one question. Can the product or service this company offers be duplicated and scaled inexpensively, or does the company need to constantly reinvest to produce it? In terms of pricing power, ask yourself how you as a customer would react to a price increase. If a gas station increases the price of fuel compared to other gas stations, would you continue to fill up there or try to find a cheaper gas station? What about your cell phone or your favorite drink? In times of inflation, you should invest in extraordinary companies that are able to easily set higher prices for their goods. You should avoid owning shares in ordinary companies in industries with a lot of competition, which have difficulty raising their prices even in normal times. Let's have a look at another great advice from the big man himself.
The best investment of all, I mean, if you're the leading brain surgeon in town or the leading lawyer in town or the whatever it may be, you don't have to keep re-educating yourself to be that in current terms. You bought your expertise when you went to medical school or law school in old dollars, and you don't have to keep reinvesting. And you retain your earning power in current dollars.
Another way to keep up with or even participate in inflation is to invest in yourself. With each skill you learn to master your craft, you make yourself irreplaceable, which greatly increases your pricing power. And the good thing is that this knowledge and skill will stay with you forever, but you will have paid for it in old, devalued money. Don't forget to like and subscribe.